Why the Toronto housing market is completely broken? Stay tuned to find out exactly what I mean. Promise you, it'll be worth it. Good day, Toronto. Welcome to another episode of Prime Properties TV. So glad you joined me here today. I'm going to go through a couple articles with you, but there's a couple charts I want to go through to show you exactly why the Toronto real estate market right now and the way that we're heading towards is kind of broken, right? So that's topic number one. The second topic we're going to be going through is how that they're planning on clamping down the use of home equity lines of credit or Helocs. And then we got another print about inflation being really high. And of course, as what I've been saying in all of 2022, we got another pre-con disaster, right? So without further ado, here is the first chart I want to show you. Now, if you've been watching my content for some time, you can see this is a chart I've been using quite a lot. And this basically shows you kind of the idea of what the price movement is on a month-to-month basis based on the months of inventory, right? So you can see over here that if your months of inventory, which is 5, which is the balance, then you can see that prices hover around 0 to 1% change month over month, right? And the red dots over here, which is 2021 and 2022, has been, absolutely bonkers. So your price change every single month is like 3 to 4%, and that will cluster, and we have less than 2 months of inventory. Now, the reason why the housing market is completely broken, why this chart is broken, is that the idea was that prices don't really fall until we get to kind of a balance or buyer's market, which is somewhere between 4 to 5 4 to 5 months of inventory. But right now, for the first time ever in a very long time, you can see right here, April 2022, 2 months of inventory, which is still very much a seller's market. But wada boom, bam, dropped 0.5% when adjusted for the HPI benchmark. So this is really, really weird. And it was the first time it's ever happened. So this is going to throw off a lot of people. And I actually still think that there's more room for the prices to come down, obviously depending on which market you're going to be in. So if you're on my newsletter, you'll see that there are obviously micro markets that got hit the most, right? And some of them be like the detaches in the Milton area. So those obviously took a bigger hit than most, but obviously you're going to have the homes that came down 10, 15, 20% because the sellers are highly motivated to sell because they have to close another property, right? So that's what ultimately drives down some of these kind of one-offs or maybe like 10, 20, 100 off kind of properties. And what I'm going to want to see is where the inventory is and where the prices are going to be in the summer, because the whole cluster of people who call it bought at the peak, and I talked about it in last week's video, you can check it up here. They bought at the peak and they have to sell their home for less than what they thought it was worth because they bought first. Those homes should technically all close by like June, July, because I don't really see a closing that's like, more than like 3 to 4 months. That's kind of like the norm, right? Even on the longer side. So once those kind of pass us by and call it like mid-summer, right? So, if you bought in February, March, and then 3 to 4 months close, that puts you like June, July. If those close on time, I think we're not going to have that cluster of pressure for people to press down. And then we'll see whether the market's going to stay this continued price drop or people are going to take stuff off the market, and we'll see. And at the same time, there's going to be a mix of kind of like the inflation talks and also the June and July interest rate hikes and where that's going to be. So at the current moment, this is what it looks like. And it's so weird. It's just like a little dot off on its corner. It's like that kid who no one wants to play with over there in the corner. It's bad. But here's a couple of other charts I'm going to show you, right? So you got your change in active listings. So active listing, on the way to kind of explain it, is how many properties are on sale in the market, right? Now, obviously, this is a little bit skewed sometimes, depending on some people kind of like delisting and listing. But you can see that basically in 2022, it's the highest ever since 2010. Right. So we're getting a lot of inventory built up. So when you go back to the chart previously, the months of inventory that's over here can continue probably moving to the right. The question becomes how much further below the prices are going to come down. Right. But if kind of like prices stagnate this way and we increase some inventory, then we go back this way and we may get back to kind of like the little cluster over here. But if we continue seeing prices down and we go down this way, we're in for a treat. So that's why I want to show you the active listing. It is very, very high right now and continues to be high. The question is, are people who need to sell going to continue listing their homes, or are they just going to wait it out? And that's a question that no one has the answer to. Then you got the next chart here. It looks a little bit complicated, but essentially, in short, the orange line that's highlighted is year over year price change in terms of housing. And usually you want to use year over year in kind of big data like this so that you can see seasonality taken out. And then the blue line is the sales to new listing ratio, which is kind of like the inverted of months of inventory. So the higher the percentage, the more of the new listings get bought and sold. So you can see that the house prices trail the sales to new listing by about like 6 months, give or take, right? So you can see that when the blue line goes up, generally the orange line follows and the orange prices goes up. And when it comes down, it goes down. And you can see that right here in 2021, you can see that the blue line went really high and then the orange line went shroom straight up. But now you can see that the price sales to new listing ratio is dropping down. So when you're below 50, like in the 40, you're almost entering buyer's market / you are in buyer's market, depending on your interpretation of this. So where is this going to be for where are prices going to be in 6 months? Generally, this is the leading indicator. If you like a lot of these charts, then make sure you help us spread the knowledge by smashing the like button and subscribing to the Prime Props channel, because every single week we put out useful content and information for you guys out there to give you an idea of what the lay of the land is right now in the real estate market, because there's a lot of stuff out there, like I've been saying, and because you need really a lot of critical thinking to kind of analyze what's fake news, what's real news, and what's not good news, because everyone's trying to drive a narrative depending on where they're coming from, right? Obviously, us being realtors, we're kind of trying to provide good advice to our clients and give you an idea of what's a bit, like honestly, we're pretty agnostic, meaning like I don't care whether the market's going up or down, because most of our clients are investors and they can make money on an up and down market. It's just about knowing how to navigate this, right? So that's why we put out all this information out there for you. And if you do want to work with us, you can book a call with me using the link right here. It's www.chatwithzen.com. Now, the first article I'm going to talk to you about here is Canada's banking regulator to tighten the mortgage HELOC rules to curb rising homeowner debt. So OFSI, again, if you aren't familiar, is the guys who kind of control the kind of bank regulations. They're the ones who came up with the stress test. And now they're coming up saying that, the HELOC is putting the economy at risk, specifically one type of HELOC, which is called the readvanceable mortgage. So in normal people English, what that basically means is there's a very popular mortgage product that everyone's been getting. And it's every single month when you pay off a portion of your principal, you get that back in the form of a line of credit, which is a HELOC, home equity line of credit. So every single month you pay it off, you get another line. So an example would be if you have call it $2,000 mortgage payment, 1,000 of that pays off interest, 1,000 of that pays off your principal. Every single month you pay that monthly mortgage payment, the line of credit that you pay off, the $1,000 in principal, you get that in the form of a credit. So it becomes a revolving amount. Now, this has been a very popular product for anyone who does like Smith maneuver, which is you basically take it out maximally to increase your kind of tax refund in April. I'm not going to get into much, but this could basically kibosh it. Another component of this is they're saying that the line of credit, because it's attached to a house as a collateral, the interest rates are very low. So it's a very good way to mask kind of insolvency in families, right? So an example is if you have a really large line of credit because prices have gone up really high and your line of credit gone bigger, and maybe you're spending it like wildly like crazy, but you're not defaulting on anything because that line of credit, you're constantly just paying the interest portion back. It's hiding the fact that the family's at risk and they borrowed too much money and they're over levered. And this happens very often because a lot of people, when they see that much money, they just spend, right? And they're not really responsible with it, right? So that's kind of what they're trying to, tighten. Now, the interesting thing is that they want to fix the way it's written, meaning that they want to put more risk involved in it, right? So most line of credits right now is like prime plus 1%, which means your interest rate somewhere between like 4 or 5%. Most mortgages right now is like prime minus 0.5. So there's like a 150 basis point spread between that. So the interest rate's still very low, but they want to increase the classification, that's not a word, category of risk so that your interest rate on that is a little bit higher, right? Because your credit cards are like 20%. Your regular unsecured line of credits are like, 8 or 9% right now. So the increase of that, then maybe it kind of takes away some of the incentive to keep borrowing from it, right? And that's kind of what they're doing. Now, the key thing that I have an issue with in all of this is obviously trying to tighten the rules on kind of like each Canadian family's kind of finances. But obviously, is also the same person that would have, or same company or an institution that would have changed the down payment rule for investors. And I've been kind of harping saying, if you want to slow that down, they should, but they still aren't. And the reason why that's important is because if you look at this chart over here, this shows you how much HELOC is actually used right now. And you can see that it's just gradually increasing, right? Obviously, you see what the price is. But the thing is, a lot of people use HELOCs to buy investment properties. So if you have a $500,000 property and you buy $1 million property somewhere, you're borrowing $200,000 to service that. So it's actually very common for a lot of people who are investing in pre-construction to always just use the line of credit to pay for the interest, pay for the deposits on that deposit schedule for pre-construction. And you can see that when you increase the risk and interest rate of the line of credit, it doesn't necessarily stop people from spending the line of credit that they have on investment properties. It just makes it that, the returns are a little bit less because interest rates are higher. And the orange portion here is the amount of maximum Heloc. And you can see that the blue line is how much has already been drawn out. So you can see that more than 50% of the line of credit has been drawn out. So if you're spending this on, say, non-investment related stuff like non-real estate stuff, that's a really big budget for your fund budget. But if you're investing this with real estate because the deposits are so large or you buy other things, then obviously this can be a systemic risk when all the rates go up because HELOCs are affected by interest rates. And that's kind of what they're trying to clamp down. So while they're trying to make sure that we don't go into like a bubble crash kind of thing, I think it's probably better if they did the kind of 35% or 30% down payment on investors, because then they wouldn't even be utilizing this because it doesn't make as much sense because you're putting so much money in. Granted, obviously some people can still do this if they have a really big line of credit and still put 30% down into it, right? Now, the other thing I want to run by you is when interest rates are going up because of the whole pre-construction space, there's a interesting chart I'll show you right now that shows you the monthly cash flow. And if you know kind of what I'm about when it comes to investing, I'm very adamant on cash flow. And cash flow has essentially been non-existent for a lot of condo investors. And most of our clients who buy investments in the condo space tend to be people who have really large portfolios and they just want something for like lifestyle use, whether it's for their kid or for themselves. And when you adjust for the cash flow and don't include like the tenant paying down the mortgage for you, it's always been like minus quite a bit, right? So like when we were doing pre-con or even buying stuff, it was like somewhat positive, you could kind of break even. And then when we stopped doing pre-con like 2017, 2018, it started getting negative and the condos start making no sense. But when the interest rates are very low, your principal that you're paying back is very high. So when you adjust and you add that into kind of your kind of monthly amount, and you can see that it's dipped below this $0 amount on the orange side, it basically shows you that even if you include the monthly mortgage pay down, you're still not breaking even on these condos because the price is A, too high, and two, you're not getting enough rent for it, even if you include the mortgage being paid down. And as interest rates go up, more of that goes towards interest and less of it goes to principal. So it really messes up with your numbers. So while I do think condos are probably gonna do really well because it's the entry-level product that a lot of end users can do, it may get not as popular anymore with investors because the numbers just don't make any sense, right? There's this whole idea, it's like risk-free return, right? People want no risk and they want return. But in this case, if you're getting no cash flow and when you adjust it for principal repayment like mortgage pay down and you're getting no return, this is just return-free risk. All you're doing is speculating. So my challenge with all of this is if you're buying a pre-con, and this is why I'm not hating on pre-con, but like been telling everyone to be careful of it because the pre-con space, now you're buying at even a higher premium and the rents aren't going to make sense, right? So Urban Nation came up with the stat where right now with the way that the cost per square foot in pre-con has gone up like 20-25% or so, you need $6.35 per square foot that you bought to break even. Rents right now in all of GTA per square foot is $3.50. So you need rent to double for you to break even. That means you're really well underwater right now. So you really got to be careful when it comes to pre-con, because if you're going to be negative carry plus the principal recapture isn't there, then it's a really bad investment and you're only just kind of banking on appreciation. And then when you mix that with all the people who are buying pre-cons to flip, even though it's been warning it's a terrible idea, that's a giant kind of bubble waiting to pop when these buildings come due if the market doesn't get up to where it is right now. So you really got to be careful about what you're buying and what you're investing in, because when the market is hot and the gravy train is going, everybody looks like a genius. But when things start turning and you don't understand the systemic risk that's happening in the market, that's where you're going to lose a shirt. Yeah, just be careful. All right, so the next article you got here is Canada's inflation rate hits 3-decade high of 6.8%. Yeah, we knew that already. I said that I think last month because they're including for the first time used cars that's going to go up. But I think I talked in last week's episode. You can check that out here. We're probably going to follow US and probably like flatline very soon just because of the base effect, which is basically comparing last year to this year. And when you compare this year to last year, we're probably already stuck at the 6 to 8%. So, you know, when you're stuck at 6 to 8%, the rate of change is actually zero or very little. It's not like prices are going to come down. It's just they'll stop increasing as high. So your gas will probably still be at that amount if you're just strictly looking at that. The thing that I find absolutely wild here is like, where are they finding food costs? Or is it? Where are they finding food costs at only 9.7%? I want to know where they're shopping, because I'm pretty sure last time I went to go buy some beef or like some steaks, they're most definitely up at least 50%. So again, question and think critically about what the CPI is pitching you. This thing is a whole hoax, it's a joke, right? But again, we're always using this as a metric in some of our analysis. But I think the kind of ruler that we're measuring with is off. That's all I'm trying to get at. And then we got the last article here. Buyers say Mississauga developer holding deposits hostage after a project went messed up. Oh boy, all right. So this one, I'm not gonna bore you with the details, but essentially, you know how sometimes when a builder cancels a project and they return a deposit, these people are now, these people as in like these builders are holding that deposit that they have as hostage, saying that these buyers are in breach of the contract and now they're going to hold their deposit. Even though this project, this piece of land got sold to another builder to continue developing, which is a crazy thing because if you read kind of like, the narrative part of this piece, they know that even if the new builder provides them opportunity to buy in the existing development, they're going to be priced out of it, which I've seen a lot of already, right? Because when one builder kind of collapses and another builder comes in, they're not going to have a charity case and sell it back to them for what they originally bought it for. They'll give them kind of like a first right of refusal, meaning they can buy it first without fighting, or maybe they'll give you like a 5-10% discount. But that 5-10% discount is still nowhere close to what these guys bought it for in 2017, right? So you just got to be extra careful. But the technicality on where they were saying that, I don't know where it is in the article, but the technicality where they're saying that they breached it was, they had the 2 weeks to provide financing. And it's very common that the builders won't chase you for it, right? But if that was a condition for you to kind of provide to the builder, then they're using that point right now by you not providing them like a mortgage letter that you've breached the contract. And this is just going to get into litigation. And I just feel really bad for these people, because if you have like $150,000 tied up to this, the project has been canceled and now you have to go fight to get your deposit back. It's rough, man. It's just really rough. So I feel so. So like if you guys are watching, it sucks, but these are the kind of the bad apple developers that make a really bad name for all the other like decent, good developers out there. Anyways, hopefully this gives you guys an idea of what's happening in the market. I know it's a little bit slower of a news day, which is great because it was a long weekend, and I hope you enjoyed yours. But if you're looking for help, whether you're buying, selling, or investing, our team helps a lot of clients with that because we are realtors and we can help you with what you're looking for right now. So if you want to kind of book a strategy call with me, you can use the link right here. It's www.chatwithzhen.com. Until next time, your move, your future. See ya. Now that you're done watching this one, how about this one? Oh, you know what? This one's good too. Ooh, this one's really good. You know what? Just watch them both.